Good morning, good afternoon, or good evening, wherever you are tuning in from. It is Friday, February 27, 2026. Welcome back to the Japan Stock Podcast.
Yeah, thanks for having me back.
Always a pleasure. So today we are looking at the Japan markets, and we're going to crack open the hood, literally, on a company that feels like a massive paradox.
It really is.
Right. On one side, they are manufacturing technology that feels like it belongs in the dawn of the industrial age. And on the other side, they are currently launching components into space on the H3 rocket. We are talking about GS Yuasa Corporation.
It's a fascinating case study in corporate evolution.
Yeah.
They just released their Q3 financial results for the fiscal year ending March 2026. And if you just glance at the headlines or the stock chart, you might actually miss the real story happening underneath.
Exactly. And my mission today is simple. For everyone listening, we aren't just going to read numbers off a spreadsheet. We are going to find the hidden business logic here. Because, let's be honest, when most people hear batteries in 2026, their brain immediately goes to high growth, Tesla,
Right.
solid state. Right. They don't necessarily think of a 100-year-old Japanese manufacturer, best known for the heavy lead-acid block sitting in your gasoline car.
And that is exactly the misconception we need to clear up today.
Yeah.
Because GS Yuasa's story right now is incredibly complex.
Yeah.
I mean, it involves hyperinflation accounting in Turkey, which is a headache in itself, a massive strategic bet on Honda, and technology that is literally sitting inside satellites right now.
Okay, so let's unpack this. We have a lot to cover. But before we get into the messy details of the Turkish lira or the rocket science, let's ground ourselves. Who exactly is GS Yuasa? I see their logo on car batteries all the time, but are they just a commodity parts supplier?
Well, they define themselves as an energy device company, which is a very deliberate choice of words. You have to remember, this company is the result of a massive merger back in 2004 between Japan Storage Battery and Yuasa Corporation. So we are talking about over 100 years of history here.
Ah, the old guard of energy.
Precisely.
Mm-hmm.
But they have this dual identity. On one hand, you have the bread and butter, which is lead-acid batteries. This is what starts your car, your motorcycle, powers forklifts. It's commoditized, it's gritty, it's heavy, but it generates serious cash.
All right.
And then on the other hand, you have the growth engine, lithium-ion. This is for hybrids, EVs, submarines, satellites, and yes, the H3 launch vehicle.
Yeah, I saw that in their technical reports. They actually have a whole bulletin specifically about the lithium-ion battery for the H3 launch vehicle. That is serious engineering. It feels like a flex.
Oh, it is a massive flex, and that's the tension an analyst sees here. They are balancing this innovation and growth philosophy with the gritty reality of manufacturing standard automotive parts. And crucial to this identity is their relationship with Honda.
Okay, how so?
Well, Honda isn't just a customer. They hold equity in GS Yuasa's joint ventures, like Blue Energy, and the new R&D company they established together back in 2023.
So they are deeply embedded. This isn't just a we sell batteries to whoever buys them situation. They are structurally tied to Honda's roadmap.
Correct, and that context is absolutely vital for understanding their performance right now.
Which brings us to the present. February 2026. They've released their Q3 results covering April to December 2025. What's the headline here?
The headline is relief, and perhaps a bit of optimism. They recently revised their full-year forecast upward.
Upward is always good. What's driving it? Because I recall hearing about some headwinds with currency and raw materials recently across the entire manufacturing sector.
Yeah, it's been tough. But there are three main drivers for this performance over the last year or so. First is price versus cost. They have successfully managed what they call selling price corrections.
Meaning they raised prices.
Yeah, exactly. In the Q1 data alone, they showed a positive impact of over 1.1 billion yen just from raising prices to match cost increases.
Wow. That is the definition of pricing power, isn't it? Being able to pass the bill to the customer without losing the sale.
To an extent, yeah. It shows their position in the supply chain is sticky. You can't just swap out a battery supplier overnight.
Right.
The second driver is volume, specifically in the ASEAN region, Thailand, Vietnam. Sales volume there, particularly for motorcycle batteries, has been incredibly strong.
The scooter armies of Southeast Asia.
Exactly. It's a massive, massive market. But, and here's where an investor really needs to put on their reading glasses, there is a third driver, a special profit.
Ah, the dreaded one-off.
Or the beloved one-off, depending on how you look at it. They recorded a 1.6 billion yen gain from selling idle land, fixed assets.
Okay, so that fluffs the net income. It makes the bottom line look shiny, but it's not core operational growth. I mean, you can't sell the same piece of land twice.
Precisely. And analysts would strip that out to see the real health of the business. But even without it, the fact that they are liquidating unnecessary assets and managing margins shows a disciplined management team. They aren't just growing by selling more, they're growing by being more efficient. They're cleaning house.
So efficiency is up, pricing power is real, and they are cleaning up the balance sheet. But I want to talk about the elephant in the room, or maybe I should say the inflation monster in the room, Turkey.
Ah, yes, the Turkey situation. This is probably the most counterintuitive part of their whole earnings report.
I was reading through the notes and I saw references to IAS 29, which sounds like a sci-fi droid, but I know it's an accounting standard. What is going on there?
So Turkey has been experiencing hyperinflation. The accounting rule IAS 29, financial reporting in hyperinflationary economies, kicks in when cumulative inflation exceeds 100% over 3 years.
100% inflation. That is wild to even think about.
It is severe, so Yuasa has to apply special accounting adjustments using the Turkish CPI, the Consumer Price Index Conversion Factor. Basically, they have to recalculate their Turkish subsidiaries' numbers to reflect the current value of money.
So does this mean they are losing money there, or does it just look like they're losing money? Or conversely, does it look like they're making billions because the currency is so inflated?
It creates a lot of accounting noise in the operating profit. The reality is really a mix of both. The business environment in Turkey is genuinely struggling due to market stagnation. I mean, people buy fewer car batteries when the economy is crashing.
Sure, that makes sense.
But the numbers are also distorted by this accounting rule. It makes year-over-year comparisons incredibly difficult.
Right. It's a double whammy. Bad market, plus a rule that makes the books look chaotic.
Exactly. But management has been proactive here. They've stated they put a cap on the risk in their latest forecast. They are essentially saying, we know this is volatile, we've boxed in the potential downside, so it shouldn't surprise us further.
That's reassuring. It's like, we know the house is on fire, but we've closed the door to that room. Okay, so Turkey is the problem child right now. But you mentioned ASEAN as the star performer. Let's dig into that. Why is Southeast Asia doing so well when Europe is struggling?
It comes down to the nature of the demand. In Vietnam and Thailand, the demand for replacement batteries is relentless. It's a cash cow. You have millions of motorcycles and older cars that need new batteries every few years. It's not dependent on people buying new vehicles. It's dependent on them using the ones they already have.
That distinction is huge. Replacement versus OEM sales. One is cyclical, heavily dependent on the economy. The other is almost inevitable.
It's the single most important variable in their lead-acid business. And don't forget Australia.
Australia? I didn't realize there are big players down under.
Oh, yes. The reports highlight the Made in Australia brand strength. They have managed to keep sales volume robust there because they have a local manufacturing presence that the market really trusts.
Yeah.
It's a very steady hand in their portfolio.
So we have the chaotic Turkish market, the booming Southeast Asian market, and the steady Australian market. It really shows the benefit of being a global conglomerate. You have that geographic diversification.
And even in Europe, outside of Turkey, their UK-based subsidiary GWAR is seeing good sales in replacement batteries for the continent. So the old world isn't dead yet.
Let's pivot to what I think is the most interesting part of this deep dive, the hidden business logic. We talked about the company identity earlier, but I want to challenge a basic assumption.
Yeah, which one?
The assumption that EVs kill lead-acid batteries. I feel like if I bought GS Yuasa stock, I'd be worried that in 10 years, literally no one needs a lead-acid brick anymore. But looking at these financials, the overseas automotive battery segment is a monster. We are talking a projected 250 billion yen in revenue for the full year.
Compared to about 100 billion domestic, yes.
Yeah.
This is what we call the replacement mode.
Replacement mode. I like that. Explain it for us.
The market assumes a linear transition, right? Internal combustion engine goes to 0, EV goes to 100, therefore lead-acid goes to 0. But the reality is much more nuanced. First, hybrids. Hybrids still heavily rely on 12-volt lead-acid batteries.
Yeah.
Second, even pure battery electric vehicles often use a 12-volt lead-acid auxiliary battery for safety systems, lights, and locks.
Wait, really? An EV has a lead-acid battery in it?
Many EVs still do, though some are starting to move to low-voltage lithium-ion. But think about the redundancy aspect. If your main high-voltage pack fails, you still need to be able to unlock the doors, roll down the windows, turn on the hazard lights. Lead-acid is cheap, it's reliable, and it works perfectly in freezing temperatures.
Okay, so the tech isn't dead at all.
Far from it. But the bigger factor is the global fleet. Even if every new car sold today was an EV, there are still billions of gas cars on the road. People are keeping their cars longer. The average age of a vehicle is increasing. And every 3 to 5 years, that car needs a new battery.
So it's a recurring revenue stream. It's almost like a subscription model, but for hardware.
Exactly. And because GS Yuasa is so strong in the aftermarket, the replacement market, they aren't as vulnerable to a dip in new car sales as a parts supplier for engines might be. That 250 billion yen overseas revenue is built on the back of cars that were sold 5, 10, even 15 years ago.
That is a massive buffer. It buys them so much time. Which actually brings us to the second key variable, the lithium-ion bet. Because they aren't just sitting on their lead piles counting cash. They're actively pivoting.
And this is where the Honda partnership becomes critical. You have to understand, GS Yuasa isn't trying to be CATL or BYD. They aren't trying to make millions of cheap batteries for every single car maker on Earth.
Right, they aren't fighting the volume war with the Chinese giants. That seems like a suicide mission for a Japanese manufacturer at this stage anyway.
It would be incredibly tough. Instead, they are embedding themselves into Honda's high-performance supply chain. They established the Honda GS Yuasa EV battery R&D joint venture in 2023. They are building new plants together. Their entire strategy is high capacity, high output.
And high tech. I was geeking out on those technical reports earlier. They are publishing serious research on solid-state electrolytes and silicon-negative electrodes.
This is highly significant. It proves they aren't just an assembly shop putting bot cells into packs. They are doing fundamental material science. Silicon-negative electrodes are essentially the holy grail right now for increasing energy density. It's about making batteries hold more charge without getting physically bigger or heavier.
So they are essentially using the profits from the lead-acid business, the cash cow, to fund this high-stakes R&D for the next generation.
That is the core strategy, yes. But there's a third variable we shouldn't overlook. The sleeper hit of their portfolio, industrial and infrastructure.
This is the stuff that isn't in a car at all.
Correct. The sources mention strong demand for data center backup power, UPS or uninterruptible power supplies.
Oh, right. In an AI-driven world, massive data centers are popping up everywhere, and they absolutely cannot go down.
100% uptime is the baseline requirement. If the grid flickers for even a second, you need a massive battery bank to kick in instantly. GSU also makes those. They also make storage batteries for railways. This is the infrastructure side of the business. It's less flashy than electric vehicles, but it's high margin and it's growing rapidly with the digital economy.
So you have the replacement moat in cars, the strategic pivot with Honda for EVs, and this sleeper hit in data center infrastructure. It's like a three-legged stool.
A very stable stool, provided they manage the capital allocation correctly.
Well, let's talk about that. Shareholder returns. How are they treating the people who actually own the stock right now?
The philosophy here is very professional and steady. They aren't throwing wild cash parties, but they are incredibly consistent. They prioritize strategic investment like building those massive new battery plants for the Honda joint venture.
Which makes sense. You can't pivot to EVs without spending billions on actual physical factories.
Exactly. But they do maintain stable dividends. And they are very aware of capital efficiency. Management mentions ROE return on equity frequently, and they've done buybacks when appropriate. But the sources clearly highlight that they are currently in a heavy CapEx phase.
CapEx meaning capital expenditures, spending money to build things.
Yes. So as an investor, you shouldn't expect a sudden, massive special dividend right now. They are pouring the concrete for the future. They're aiming to reward long-term holders through a steady total return ratio. But the immediate priority is clearly ensuring they survive and thrive in the lithium-ion era.
It's a very disciplined approach. They aren't gutting the company to boost the stock price for one quarter. They are building for 2035.
Which is entirely consistent with their Vision 2035 roadmap that's outlined in the reports.
So, bringing this all together, we have a 100-year-old company navigating what is essentially the valley of death for legacy manufacturers. The tricky transition from the technology of the 20th century to the technology of the 21st.
That's the perfect way to frame it. On the positive side, they have the ASEAN dominance, they have incredible pricing power, which they clearly proved this year, and they have technical depth that goes literally all the way to space and defense.
And on the risk side?
Well, Turkey's economy remains a wild card. The speed of the EV transition is always a risk. If it happens too fast, their lead-acid moat dries up sooner than expected. If it happens too slowly, their expensive new EV battery factories just sit idle. And of course, there's the sheer cost of this ongoing investment.
It's a delicate balancing act.
It is, but they seem to be managing the balance sheet very well, keeping the debt reasonable while making these massive bets.
You know, it reminds me of that old saying, dig the well before you are thirsty. They dug the lead-acid well 100 years ago, and it's still full of water. And now they are frantically digging the lithium well while the sun is beating down.
A very apt analogy.
So here is the final thought I want to leave everyone listening with today. We've looked at the numbers, the tech, and the regions. But if you strip all of that away, the core dynamic here is this massive transfer of wealth from the past to the future.
Right.
They are funding their future, the lithium-ion, the solid-state research, the Honda partnership entirely with the profits from their past, the lead-acid replacement batteries. The real question for the next 3 years isn't really about their technology. We know they can build good batteries, they put them in rockets.
The technology is definitely proven.
The real question is about their timing. Can the cash cow in ASEAN keep producing milk long enough for the Honda EV bet to pay off? If the lead-acid market crashes before the EV factories are fully profitable, they are in serious trouble. But if they can time this bridge perfectly...
And they emerge as a dominant player in both worlds.
Exactly. And that is the hidden logic of GS Yuasa.
It will be fascinating to watch the next few quarterly reports just to see if that bridge holds firm.
We will definitely be watching. That's all for today's deep dive into GS Yuasa. For everyone listening, if you want to geek out on the science of solid-state electrolytes or see exactly how they handle hyperinflation accounting, I highly recommend checking out their technical reports and financial summaries. They are surprisingly readable.
And very informative.
Thanks for tuning in to the Japan Stock Podcast. We'll be back soon with another look under the hood of the Japanese market. Until then, keep learning.